Less than a minute away from today's labour force update, though, from the Bureau of Statistics. The jobs figures, in other words, we'll bring in our business editor, Ross Greenwood. Ross, what are economists expecting from today's figures?
Now, oddly enough, after a big jump in unemployment last month from 3.5 to 3.7%, today it's expected it will drift down to 3.6% with more than 50,000 jobs created. That number will be dropping very, very shortly. We'll bring it to you as soon as it does. The reason for that is because in January, it's a seasonal month. A lot of people are actually changing jobs or indeed stay out of the workforce until late January. And here's the number. So it's come in actually lower than anticipated, 3.5%. So effectively, the unemployment rate has gone back to where it was in December. And this really, again, shows that Australia's jobs market remains very strong. There's no doubt. It's one of the things that keeps Australian families going as costs and interest rates have been rising. But given some of the catastrophes that have been taking place in global banking, the Silicon Valley Bank being one of them, but also Credit Suisse and the panic overnight in Europe, there's almost a 0% chance on money markets that the Reserve Bank is going to raise interest rates again, notwithstanding this strong jobs data that's just been released.
Yeah, so having a look at it just briefly before we go into Credit Suisse, so it's nearly 75,000 full-time jobs created, 10,000 part-time. So that sort of speaks to this month, I suppose, doesn't it, Ross? That's the normal time of year when you're starting full-time employment, and that number's got a big boost in it, and that's the one that obviously a lot of people watch pretty closely in terms of the strength of the Australian jobs market, which, I mean, this is still an incredible, looking at it in isolation, unemployment figure, isn't it?
Well, it really is, because the second thing is the underemployment rate is 5.8%, and that's previously been in double digits. So you can see here just where the unemployment rate has gone to over a period of time. But do then consider last year there was they said 400,000 people close on that came into Australia during that time. And so you've actually got the number of people coming back to Australia really starting to rev up. The 350,000 people expected to arrive this year. And so to maintain the unemployment rate at these levels shows, A, that there was a yawning gap in the supply of labour post the pandemic and our lockdowns, and then B, despite the fact that people are coming home, that companies, government, whatever, are still, sort of basically gobbling up those workers as they possibly can. Business conditions we saw earlier this week were still very, very strong, despite the fact that consumer confidence is close to 30-year lows. So there's a disconnect, really. So here's the key numbers which come out. The number of hours worked is up. The participation rate is up. The underemployment rate is, down. The employment numbers are up, as you say, 64,000. That leads to an unemployment rate of 3.5%. Full employment. This is good news, by the way. This is good for Australian families. It's the way in which they cope with the rising prices and the rising interest rates.
So you mentioned there, despite all this green, we're not going to see the interest rates go up, Ross. That's your confident prediction. We've had Silicon Valley Bank. We've spoken about the fact that essentially was a bank that had a whole lot of deposits, invested them in bonds, 95% of them, basically Rule 101 in not being diverse enough. What about Credit Suisse? It has been troubled for a few years. Is this the genuine chance of, a ripple effect? Are we overreacting to this because of what just happened with SVB? What's the risk here?
The risk is that given the fact that Credit Suisse is a globally strategic bank. In other words, almost too big to fail. But the fact of the matter is its share price is down 72% in the past year, dropped by 24% just overnight, with the fears that this contagion from the United States would really play out in Europe. As a result of that, the Swiss Banking Authority, it's equivalent to our Reserve Bank, put out a statement of support saying that it was prepared to put money in. You can see it here. Basically, the Swiss National Bank, that's its equivalent of the Reserve Bank, the Swiss Financial Market Supervisory Authority, the equivalent of APRA, assert that the problems of certain banks in the USA do not pose a direct risk of contagion for Swiss financial markets. But what is also being reported in the Daily Telegraph in London this morning, our time, is that there has been a significant meeting of global banking authorities overnight, basically to discuss this problem and whether there is a fallout, because there were big falls in Deutsche Bank, and a range of other significant banks in Europe overnight, which also gave cause for concern about the broader impact of these falls. You can see here again,
so,
the ASX 200. Since this number has come out, it's pretty much flat. So the unemployment rate hasn't had any impact on it. But really the big fall, and it's largely mining companies. I'd say our banks have held up pretty well considering what happened in Europe overnight. You can see here down around 125 points as we get away.
Yeah, that 7,000 mark's almost become a curse every time we go past it.
It really is, isn't it? So, so that's mainly where most of the hurt comes from. Rio and BHP, two of our biggest companies. But you can see, actually, strangely, as commodity prices fall, because if economic activity around the world falls, then that impacts commodity prices. That's the reason why you've got Rio Tinto, BHP, South 32 amongst the heaviest fallers of the biggest companies on the market today.
All right. Well, it's... look, it's a concern, but we'll see what comes of it. A lot of these things, sometimes there's a bit of a panic and then it all dies down. We will see. Ross, thank you.
Quite okay, Tom.